Hello and welcome to Tax Matters. I am Chiamaka Ohaochi. How was the Christmas and how are you gearing up for year 2020? Our prayer is that 2020 will be a year of uncommon testimonies for us all. Last episode, we served you the first part of the 5th edition of the National Tax Debate organized by Tax Club University of Lagos. 4 teams made it to the finals, held on Friday the 20th of September 2019. And of course, because we have only 25 minutes to do this week after week, we were only able to serve you the delivery of 2 of the debaters, the representatives of Team G and Team E. Today, we want to serve you the remaining 2. The topic remains the same, a blueprint for the taxation of the digital economy. Let's get down straight to business.
London, New York or Lagos, business or holiday, home or office, you can now carry out your tax transactions from anywhere in the world. You can now file all your tax returns, pay online, get a receipt and even process your tax clearance certificate from anywhere in the world online and in real time. All you need to do is log on to www.firs.gov.ng and click on e-services and be introduced to the world of innovation, convenience and transparency from the FIRS. You can also pay stamp duty as you register a new company with the CAC or for other transactions that require stamp duty payment online. You can also file your withholding tax returns and determine the withholding tax deducted from you is in government coffers so that you can get your receipt within 45 days as long as the deduction has been remitted. Yes, all of this and more online at www.firs.gov.ng/e-services. FIRS, making tax administration as easy as ABC. Please note that all FIRS services are free of charge. This message is from the Federal Inland Revenue Service. It pays to pay your tax.
I'm here to talk about a blueprint on the taxation of the digital economy. Before I proceed, permit me to read out some very interesting facts. Did you know that Uber, the world's largest taxi company, owns no vehicles? Facebook, the world's most popular media owner, creates no content. Alibaba, the most valuable retailer, has no inventory. And the Airbnb, the world's largest accommodation provider, owns no real estate. The next question is, what is the digital economy? The digital economy is also known as the new economy, and it's simply a term used to encapsulate all economic processes, transactions, and interactions that are done through digital technologies or computer software. The digital economy is fast becoming innovative and far-reaching. According to statistics by Statista.com, it has stated that as of 2016, Uber had 50 million users, 2017, 75 million users, 2018, 95 million users, and as of 2019, Uber now has 110 million users, and the year is not over yet. In 2018, the Nigerian Investment Promotion Commission explained that the Nigerian digital economy is expected to generate $88 billion and create 3 million new jobs by the end of 2021. This is how far-reaching and important the digital economy is. However, the digital economy is not without its own challenges. These challenges include tracking transactions for the purpose of taxation, and secondly, the rule of physical presence as contained in Section 13 of the Companies Income Tax Act of 2011, which makes it difficult to tax non-resident companies. My team and I have put together a blueprint to tackle these challenges. There are 3. First, global collaboration. Second, amending our tax laws. And third, taking a cue from developing nations. Moving on to the first, global collaboration. When we talk about digital economy, 2 questions first come to mind. The first is, where is value created? And the second is, where should multinational profits be taxed? While some experts are of the opinion that multinational profits should be taxed at the market jurisdiction, which is where value is created the most, and which is where they have more users and more content. Other experts are of the opinion that multinational profits should be taxed at the resident jurisdiction, which is where they have their headquarters. A discourse of this nature cannot be done without establishing a strong legal framework for such system, bearing in mind that without legislation, there can be no taxation. As such, this brings about double tax treaties. Double tax treaties are simply agreements between 2 countries. And according to the Research Journal of Finance and Accounting, Volume 6, Number 12 of 2015, it has provided diverse benefits of double taxation. This includes 1, providing legal certainty. 2, reducing cases of base erosion and profit shifting, basically tax avoidance. 3, it allocates taxation rights between signatory countries. And 4, it attracts foreign direct investment. In an article published on mondak.com by Anderson Tax by Oladejo Adeyemi and Ikechi Chukwu on the 4th of September 2019, has shown that Nigeria currently has double tax treaties with only 13 countries, out of which 2 have not been ratified due to the provision of Section 12 of our Constitution, which makes it mandatory for the National Assembly to domesticate all such treaties. Meanwhile, developed nations like the United Kingdom has double tax treaties with 131 countries. Countries like Canada have double tax treaties with 92 countries, and even Malaysia has double tax treaties with 68 countries. Therefore, the role of double tax treaties cannot be overemphasized. Secondly, the amendment of our tax laws. The provision of Section 13 of our Company Income Tax Act implies that where non-resident companies do not have a strong physical presence, they cannot be liable to income taxation. The impact of this is that if a software company, for instance, provides services to users in Nigeria and it cannot be shown clearly that they have a physical presence, then the revenue harnessed from such transaction cannot be taxed in Nigeria. Secondly, the provision of Section 2 of the VAT Act. The provision of Section 2 of the VAT Act states that where supply is not done in Nigeria, then such income you can't extract VAT from it. Now, the case of Vodacom Business Nigeria Limited and FIRS may be a dissenting one. However, that is not the case. Because in this case, the court dissented and distinguished the fact that the bandit supplies were done through an equipment in Nigeria. And as a result of that, it can almost be said that the supply was done in Nigeria. And so that case was distinguished. In other words, the Section 2 of our VAT Act is still a problem in Nigeria. Finally, taking a cue from other nations. In India, the 2018 Indian Finance Act has made it possible for them to tax non-resident companies where it is shown that they have had a significant economic presence, regardless of whether they have a physical presence in India or not. This act came into effect in April 2019 this year. And of course, as earlier stated, this is the problem that the CETA of Section 13 has. Using the European Union as a case study, a proposal was put before them on March 2018, which seeks to create a virtual permanent establishment, which will make it possible for digital companies operating in member nations of the European Union to be taxed regardless of whether they have a physical presence or not. And this is something that the AU can adopt. A mini analysis of the income of the content creator. I presume a lot of us know that the highest content creator on Instagram is a lady called Maraji. Now, for every content she creates, she gets nothing less than 1 million. On the assumption that she creates nothing less than 2 posts per week, she gets 2 million naira in a week. And in a month, that is 8 million naira. Now, in a year, that is 96 million naira. If this were a company and we are to tax this at the annual rate of 30%, that is going to be an added revenue to the economy of 28,800,000.
The other speakers took turns to ask questions from the representative of Team L.
Now, you made mention of double tax treaties. And you said it would be wonderful if we have double tax treaties with other countries. Now, the world have about 195 countries. How practicable is it to have double tax treaties with all these countries? And wouldn't it be cumbersome? Explain to us, please. Thank you.
Okay, thank you very much for that question. Now, we must bear in mind that we are talking about, we'll be dealing with companies that have presence in different countries. Now, it is a certainty that not every online company has digital presence in all the countries of the world. So having double tax treaties is basically to protect the profit of companies that have digital presence in different countries, in specific countries. And of course, for instance, I gave example of the United Kingdom that has double tax treaties with 131 countries. Now, it's safe to say that they have these tax treaties with a lot of developed nations and even developing nations. And so no matter the online business, the digital business in question, if by the time with these tax treaties, definitely they would have covered the major countries where these businesses have an online presence.
How does your blueprint answer the issue of, or the sector of digital economy known as e-commerce?
E-commerce is basically the transactions that are done online. Now, first of all, we must bear in mind that we really, really need an amendment of our tax laws. For instance, like the section 13 of our CETA that I mentioned. Now, if this section is amended, we can tax digital businesses on a withholding basis. And we can do this through several means. We can engage service providers as tax collection agents. We can do that. We can also mandate Nigerian companies to withhold taxes on all non-resident companies. The case I mentioned earlier of Vodacom Business Nigeria Limited and FRS, the court held that a Nigerian company is required to account for the VAT on such transactions between resident companies and non-resident companies.
So you mentioned global collaboration. So I'd like to ask, if I'm sure you already know that BEPS action plans were released in 2015, and up until now, nothing has been done. So what's your time frame for global collaboration? How practicable is it in quick time? Should we wait till then?
I would like to say that that is just one of the major issues and several issues that we have in the world right now. Now, the fact that there have been several attempts to make our tax economy globally, internationally, and even domestically better, and the effect, the output has not been clearly seen and cannot be clearly identified, does not mean that we must give up trying. And so what my team and I are saying today is that we are putting forth blueprints. We are saying that, yes, indeed, of course, the way the world was in 1940 is not the way the world is today. And that's as a result of consistent effort. And so today we are saying that with consistent effort, we can get the nation to where it ought to be. Thank you.
And from a judge?
During your presentation, you mentioned the case of Vodafone and FRS. Are you trying to advise that companies that are having similar blueprint with the company in the case should follow suit with the court case and start informing their foreign vendors to issue VAT?
That case came in as a result of me talking about trying to establish the fact that even though the court had given such a decision in the case of Vodacom and FRS, it still does not change the fact that it is not in tandem with the provisions of Section 2 of the VAT Act. So no, I am not saying that position is the best. I was simply making a distinction to set the basis for the fact that our tax laws still need to be reviewed.
Now to the last speaker, the representative of Team I.
My name is Yusuf Olaoluwa, and let me show you the blueprint for the taxation of the digital economy. First, I must introduce you to the concept of the digital economy. The digital economy is the leader of a disruptive revolution that is putting rigid companies out of business. It is a worldwide network of economic activities, commercial interactions, all enabled by ICT. Presently, the digital economy is valued at $3 trillion. That's how massive the digital economy is. And so why do we need to tax the digital economy? Simple. Because we cannot afford to not tax the digital economy. What we must realize is that there is no such thing as a separate digital economy, but rather, the economy itself has become digitalized. More importantly, we need money. The digital economy is a way to resource revenue for the federal government. 2019's budget stands at 8.9 trillion, and the speculated budget for 2020 is at 9.7 trillion. Taxing the digital economy is a way to achieve this. So how do we tax the digital economy? My policy, ROPE, redefinition of permanent establishment. In the following slides, I will tell you why we need to redefine permanent establishment, and I'll give you my own personal suggestion, the digital services tax. Now, let's start with permanent establishment. Any meaningful contribution towards redefinition must first start with a close look at our laws. Under Section 13, subsection 2 of the Companies Income Tax Act, it is a requisite that to tax the profits of a non-resident company, it must have a fixed base in Nigeria. Similarly, in JGC versus FIRS, the Federal High Court ruled that unless a company has a fixed base in Nigeria, you cannot tax it. This principle is not only known to Nigeria. Under international law, it is known as permanent establishment. However, permanent establishment is problematic. The problem with permanent establishment is that things have changed. Before the economy got digitized, a company would definitely need to establish a physical presence to carry on business. Now the rules of the game have changed, and we must change with it. In India, for example, here's how they are tackling their fixed base principle. Under the Finance Bill 2018, they've redefined permanent establishment to include significant economic presence, which means that irrespective of whether or not there's a physical establishment, a company will be deemed to be taxed once it has significant economic presence. Ladies and gentlemen, even if there is no Facebook office in Ikeja, we can agree that Mark Zuckerberg's people have a significant economic presence in Nigeria and they must be taxed. It is one thing to redefine, and it is another thing to find a framework that works within the Nigerian tax frame. This framework is the Digital Services Tax. The DST is the next way towards implementing taxation of the digital economy in Nigeria. The DST is simply a way to impose a 4% levy on the gross revenue of digital transactions with Nigeria. Under my policy, once a company is deemed to have significant economic presence, the DST will apply. And under my policy too, here are the criteria before a company is deemed to have significant economic presence. 1, if it exceeds 50 million naira in annual revenue gotten from digital transactions. 2, if it has a user base of over 250,000 people who access its digital services in Nigeria. And 3, if it has entered into more than 2,500 business contracts for digital services with Nigeria. The DST is the next step towards taxing the digital economy. Ladies and gentlemen, the DST is simply a way for our laws to stop playing police and thief with digitalization. Quite honestly, our laws are too slow and the digital economy is too fast. I do commend the efforts of the FIRS in levying VAT on online transactions. Through a directive issued in August, they made the directive to start levying VAT on online transactions. However, it is problematic on 3 levels. 1 is that it increases the risk of double taxation. Quite honestly, not all the businesses who sell goods online have no physical establishment in Nigeria. Therefore, there is a high probability that those goods have already been taxed once. 2, how does FIRS intend to watch the banks when it comes to VAT exempt goods? There's a long list of VAT exempt goods, and one of them is basic food supplies. We know that the banks will charge us. How do we intend to get these charges back from the bank? And 3, very importantly, VAT by its very nature shifts the burden of taxation to the final consumer. What this means is that levying VAT on online transactions is another way for the government to tax you, the final consumer, while conveniently leaving out the digital companies it set out to tax in the first place. It is my submission that an international concerted effort is what's best. However, a key principle of international policy is that you look out for yourself first. And the DST is simply a way for Nigeria to look out for itself first. Here is a summary of ROPE, redefinition of permanent establishment. So first, right now, the FRS has the ITAS. We suggest that they upgrade it and increase it to taxable goods and services, persons and companies. 2, we suggest an amendment of Section 13, subsection 2 of the Companies Income Tax Act. 3, we request we follow the money. No online transaction goes without being to the bank first. So follow the money through the banks. And 4th, the digital service tax. The digital service tax already has best practices in Italy, in France, in Hungary, and in the United Kingdom. Ladies and gentlemen, through my proposal, I present the rope that saves us, the rope that taxes the digital economy. Ladies and gentlemen, I give you the blueprint for the taxation of the digital economy.
questions were also asked by other speakers.
You made mention of a 50 million naira
Yeah.
limit to determine when it, like how did you get to that amount? Is it arbitrary or are there factors that necessitated the 50 million naira?
Thank you very much. So in deciding that the digital services tax is what we should apply in Nigeria, I consider proposals that have been made to the EU already. So for France, when they made their DST, they said that the threshold would be 75 million pounds. However, I had to consider Nigeria's peculiarity. 50 million naira is a big amount already for Nigerians. And therefore, when a digital company has 50 million naira, it only makes sense that we tax it. Because, well, we're not as economically buoyant as France, so we don't have to wait for that threshold. So this is what I feel is the threshold best, considering the peculiarities of Nigeria's economic environment. Thank you.
Okay. It would seem to me that on your idea of following the money, you've already limited your capacity to do so, because you stated something about taxing only online companies with 15 million as their annual revenue. So what happens to companies that have less than that, say 49 million, 48 million? Does it mean that the revenue gotten from there will go unharnessed in the digital economy?
Thank you very much. So one of the very, very core principles of taxation is that it must be cost effective. You cannot expect the expense of taxation to be higher than the actual tax you get. So here's my plan. When I put my threshold as 50 million, it's because I do not want to waste time with smaller companies. So let us not get money that is not enough. When we tax, let us tax effectively and efficiently. So countries with over 50 million naira will definitely be able to give us enough to sustain the cost of taxation, therefore fulfilling one of the core principles of taxation.
Thank you for your presentation. So now, if Facebook has significant economic presence in over 50 countries and they all deduct digital tax, aside the country of residence, how would Facebook survive?
Okay, thank you very much. So, here's the thing. First off, our survival is the one at risk here, not Facebook's. So, Facebook, has survived already to a large extent. And like I said, the best solution to this is definitely an international concerted effort. But now it's a choice between who to leave, who to actually, who to enjoy out of the profits of Facebook. Facebook gets a lot of their profit from the user data they get from Nigeria. And up till now, they haven't been taxed. So my proposal is that we should definitely tax them. The possibility of a double taxation treaty still exists, and we'll wait for the OECD submission to come by 2020. And when it does, we hope that things will be better for us and Facebook. For now, it is us.
And this taxing question from a judge.
I like the fact that you mentioned that the economy has become digitized itself. But then, the question is, as the law is currently today, do you think that it taxes some digital transactions? One.
I believe that the law already is taxing some digital transactions. So with the case of the digital economy, actually, it's a case of non-resident companies. So only those who do not have a physical establishment here will not be taxed. That's actually the problem with the current state.
So the second question is, as the law is today, what are those kind of transactions that are not being taxed? Two. Just two of them.
Facebook makes 81% of its revenue from digital advertising. We're not taxing that. That's number one. For Uber, each time you take an Uber ride, you get 80% of the income. The driver gets 80% of the income. Uber itself gets 20%. Now that 20%, we're not taxing it. So those are the two examples of transactions.
Brilliant, brilliant. These young ones have rekindled our hope for a greater Nigeria. At the end of it all, Team L came fourth with 70.63%. Top place went to Team G with 74.5%. Team I came second with 89.38%, while Team E carried the day with 89.68%.
Congratulations to Team E, the winners of the tax debate 2019. Are you ready to rumble? Some nice Uniland! Congratulations!
It has indeed been exciting, very, very exciting. And once again, we say we are proud of our youths. We thank you for watching, and we pray that year 2020 will be great for you in your personal and business lives. Have a blessed year 2020.